Hey everyone, and welcome back. I am so pumped you're joining us today because we are officially on day 3 of our 30-day Options Trading Explainer series. Now, if you've been following along, you know we've been breaking down these financial markets piece by piece, making them super easy to digest. Today, we are diving deep into one of the most popular, yet honestly, kind of misunderstood concepts out there, call options. But hey, listen to me, don't let that financial jargon intimidate you. I promise, by the time we wrap up today, we're gonna make this completely simple and crystal clear, even if you are an absolute beginner. So let's just jump right in.
So imagine this scenario for a second. What if you could make money when the market goes up? Which, let's be real, is what we all want, right? But here's the absolute kicker. You only risk a strictly capped tiny amount of your capital to actually do it. Sounds a little bit like a financial magic trick, doesn't it? Well, it's not magic. That is exactly what a call option does. It's essentially the ultimate tool for getting in on the upside of a market move without putting your entire bank account on the line. If you've been sitting on the sidelines, kind of hesitant about trading because you're worried about massive unpredictable losses, well, this is the solution you've been looking for. We're going to break this whole thing down step by step so you know exactly how the mechanics work.
All right, let's kick things off with Section 1, Intro to Call Options.
Okay, as we learned back in D2, options are derivatives. That just means their value comes from an underlying asset, like a stock or an index. So here is your simplified textbook definition. A call option gives you the right to buy something at a fixed price. And honestly, that word right is the absolute secret sauce here. It's not an obligation. You're not forced to buy anything. You are simply purchasing the option, the privilege to buy an asset at a specific price, no matter what crazy stuff happens in the broader market. You pull this specific tool out of your toolbox when your expectation is that the price of the underlying asset is going to go up. And this right here perfectly highlights the incredible asymmetry of call options. If you buy a call option and the market rises just like you thought it would, boom, you make a profit. But what if you're wrong? What if the market falls or completely tanks? Well, your loss is strictly limited. You literally cannot lose more than the small fee you paid to buy that option in the first place. You get all that upside potential, but with a rock-solid safety net on the downside.
Moving right along to Section 2, the real estate analogy.
Now, I know stock charts can feel a bit abstract at first, so let's step away from the market entirely for a second. Think about real estate. Imagine you're looking to buy a piece of land, and you find the absolute perfect plot. Step 1, the current asking price is 10 lakh rupees. You know the area is developing fast, you really want it, but maybe you just don't have the full 10 lakh sitting in your bank account today. So, step 2, you go to the seller and you offer a small non-refundable deposit. Let's say 10,000 rupees is token money. Step 3, because you paid that token money, the seller agrees to lock the price of the land at 10 lakh for the next 3 months. They can't sell it to anyone else, and they definitely can't raise the price on you.
So fast forward a month. Let's say a massive new highway is announced right next to your plot, and the open market value of that land skyrockets to 12 lakh. You benefit massively here because you still have the legal right to buy it for that locked-in price of 10 lakh. It's a fantastic deal. But what if the exact opposite happens? What if, a factory gets built next door and the land's value completely drops to 8 lakh? Well, the beauty is, you are not forced to buy it. You just walk away from the deal. You don't lose 2 lakh rupees on the land dropping in value, you just lose your 10,000 rupee token. That's it.
All right, let's bring it back to the markets. Section 3, call options in action. You know that land token we just talked about? That is exactly how a call option works. The mechanics are literally identical. We're just applying them to stocks or an index instead of an empty plot of dirt. So, picture your trading screen. The Nifty 50 index, which is a major benchmark, is currently sitting right at the 20,000 mark. Let's call that our starting line. Now, you've done your research, you've been checking the news, and your analysis tells you that the market is feeling super optimistic right now. You're expecting an upward movement in the Nifty 50. Because you believe the market is going up, the direct, logical move to make is to buy a call option. You're basically paying a small token amount, which in the trading world we call a premium, to lock in your right to profit from that upward swing. And just like our real estate analogy, the outcome perfectly mirrors what you expect. If the Nifty actually rises, pushing up past 20,000, the value of your call option increases right along with it. You can then sell that option for a profit, cashing in on the market's upward momentum while having only ever risked that initial small premium. Oh, and here's a crazy fun fact for you. This kind of brilliant leverage is actually why options were originally invented back in ancient Greece. They used them to secure olive press rates. Seriously, it's an age-old trick to maximize your upside while totally capping your risk.
Okay, reality check time. Section 4, common beginner mistakes. Look, as incredible as all of this sounds, options are not some magic button for free money. Because they're so accessible, a lot of new traders fall into the exact same predictable traps. So here are 3 you absolutely need to avoid. First up, buying a call without a proper reason. Just because you have a gut feeling or you saw some random person on social media hyping a stock does not mean you should buy a call option. You need an actual data-backed strategy. Second, thinking the price will always go up. Markets fluctuate, it's what they do. If the price stays flat or drops, your option will lose value. And finally, not understanding the risk. Yes, the loss is limited to the premium you paid, but if you buy way too many options, those small, limited losses are going to add up incredibly fast. You got to stay grounded and stay logical.
Which brings us to our final part today, Section 5, Summary and Next Steps. We've covered a lot of ground today, from abstract concepts to Greek olive presses, so let's quickly lock this in so it firmly sticks in your memory. A call option is simply your right to buy an asset at a fixed price. You use this tool specifically when you expect the market to go up. You enjoy a strictly limited loss, you can only lose what you paid for the option, but you capture the profit if the price rises just like you predicted. If you keep these 4 pillars in mind, you understand the core mechanics of call options. Okay, I've got a quick bonus exercise for you. After this explainer finishes, I want you to open up any chart. It can be a specific stock you love to follow or a broad index like the Nifty 50. Look at it, analyze it, and ask yourself what its next move is. Take 5 minutes to genuinely map out a thesis for where you think that asset is heading. Building that thesis, that's exactly how you start thinking like a real trader. You look for the opportunities, you manage your risk, and you use the right tools for your specific market expectations. So as we wrap up day 3 of our 30-day options explainer series, I want you to look at your favorite stock and ask yourself the ultimate question. Over the next week, will the price go up or down? And hey, if you think it's going up, are you ready to make your call? Make sure you keep following along with the series, and I will see you right back here for day 4. Until then, stay focused and keep learning.